Good afternoon. My name is Robert Johnson. I'm a student at Southeastern University in the Master's in Business Administration program online. And this is a presentation called the Financial Analysis Case Study for Module 4 of a course I'm taking called Accounting and Finance for Managers, or BUSI 5503. In this presentation, we're going to cover a couple of major companies, both of which you're probably familiar with. The first company that we're going to cover is the Ford Motor Company. That's one that I know you guys have heard of before. It was founded in 1903 by Henry Ford himself. He's famous for obviously the assembly line system, the $5 workday, and also the 40-hour work week, which a lot of us have become accustomed to here in this country. It's a company that doesn't need to be explained. Its history is well known. Second is Tesla Inc. That's a newer company, but also one that you're probably familiar with. It was founded in 2003 by the billionaire Elon Musk. Its focus is more in this industry on renewable energy and creating vehicles that are powered by electricity rather than gasoline, which is a new innovative concept that he has well established himself in, and I think is primed to continue growing in that space well beyond what other companies in this industry are doing. So let's get into the analysis. First off is the Ford Motor Company analysis. Just a couple of thoughts here, main points that I wanted to go over. This doesn't give a full summary or indication entirely of what's going on with each of these companies, but I think it's a good start. So first off is the current ratio. Ford Motor Company, if we take current assets and divide that by current liabilities, we get a ratio of 1.2. What this means, essentially in a current ratio, is that it's their ability to pay off short-term debt in a very relatively quick amount of time if they had to. One of the things about the current ratio that isn't included is, in that they're including inventory in the current ratio. So a number of 1.2 isn't entirely accurate of their ability to do what we're talking about, paying off short-term debt or liquidating quickly, because they may not be able to always move inventory as fast as they'd like to, right? So that's why we're adding the acid test ratio in here. So the acid test ratio actually takes out inventory and follows a lot of the same concepts from the current ratio. With Ford Motor Company, once you take out inventory, that number goes from 1.2 down to 0.95. So it's not exactly what we would want to see above 1, but they're not doing horrible. The debt ratio here, which is what mainly concerns me if I were someone analyzing these companies, is that Ford Motor Company, if you take total debt and divide it by total assets, you get 0.88 or 88%, which means that they're approaching 1, almost a whole 1 in the decimal form, which means that they have a very close amount in their amount of debt to their amount of total assets. We'd like to see that be a lower number if possible. Here in Tesla Inc., going over the same numbers, current ratio with Tesla, current assets over current liabilities, you get a number of 1.9, which shows that they're actually able to move and pay off short-term debt even quicker. Once you take out inventory and you look at the acid test ratio, again, we see Tesla outperforming. Even without inventory in there, they come in at 1.5, which shows that they have the ability to pay off short-term debt, even without having to move inventory that may be hard to get rid of. And lastly, we see the debt ratio. Here is a lower number again, 0.45 or 54%, which is significantly lower than what we're seeing with Ford Motor Company. And I like that Tesla has a lower debt amount than its competition. In conclusion, based on the previously discussed points of data, I believe Tesla Inc. is both the healthier of the two companies and the better investment. It's important to note that there was an extreme disparity in both the horizontal and vertical analysis of these two companies. What I mean by that is Tesla Inc. showed growth in the bottom line, where Ford Motor Company really didn't. They actually showed decline due to a couple of factors, which I explained in the paper. These points combined with Tesla's edge in the space of green energy, renewable energy, which they're primed to continue growing in due to government subsidies, tax breaks, grants from the government, those types of financing activities. They're going to be able to see their profit margin increase in ways that I'm not sure that Ford is prepared to do. So with that, here's the references for this if you'd like to take a look at any of those. Again, my name is Robert Johnson. This is my analysis on both of these companies, and I thank you for taking time to listen. God bless.